So, welcome back to the podcast, everyone. Today's guest is Vessi Kapoulian. I hope I didn't mess up her name. The founder and managing partner of DBA Capital Group, a Los Angeles-based real estate investment firm with $80 million in assets under management. She's a former commercial lender, and she brings over 20 years of business and finance experience to her work as a multifamily investor, board advisor, and family office consultant. Today, she advises family offices on risk mitigated investments in real estate and supports their long-term strategic planning through board advisory services. Apart from being a multifamily investor herself, Vessi also provides investment due diligence and consulting services to both active and passive investors, helping them evaluate operators, markets, and deal structures with confidence and clarity. Born and raised behind the Iron Curtain in Bulgaria, very interesting, Vessi earned a full academic scholarship to study in the US. She holds a BS from the University of Arkansas and an MBA from Northwestern University's Kellogg School of Management. She is a frequent speaker at investor conferences, podcasts like this one now, and industry events. Okay, so Vessi, anything I left out that you want to add to your intro there?
No, that was very thorough. So I appreciate the warm welcome, the kind and very detailed introduction, and I look forward to our conversation.
Okay,
And
I'm looking
I
forward to
invite
it as
you to
well.
the audience.
All right,
Yes.
all right. Okay, so let's jump right into it. First question I always like to ask, I think is basic introductory kind of question is, how did you first get into real estate? What inspired you, and what was the aha moment that kind of made you focus primarily on multifamily?
Yeah, happy to share. I'm glad that you mentioned my origin story, which really started many moons ago
Hmm.
behind the Iron Curtain in Bulgaria. So very different time, very different place. But I bring that up because it definitely growing up in that environment shaped who I am,
For sure. Hmm.
how I think today about investments, including real estate. And as I reflected on my journey from beginning to where I'm at today, I often say that that seed in real estate investing was actually planted there, although it didn't quite germinate
Hmm.
until a
Hmm.
few years later. But at the time in Bulgaria, when people talked about investments, I would argue even to some extent today, they typically refer to hard assets, so
Right.
real estate being one of them and not as much to the stock market or other vehicles. At the time, there was no stock market to begin with. But anyway, so that was the exposure that I had as far as conversations and what
Hmm.
I saw people do with their investable cash. But like most people, I followed the traditional path. It was always my dream to come to the US. I'm very grateful that I was able to make it happen, earn this full scholarship, which was the only way to really make it happen. So there was no
Right.
plan for me.
Okay.
And like many people, I started down on the traditional path of going to school, then graduate school, then joining a large corporate firm and feverishly climbing that corporate ladder of success. And
Hmm.
what success meant to me at that time was reaching that top of the corporate ladder, right?
Right.
So I did that for many years until a few events of diversity caused me to realize that I had been climbing the wrong ladder. And some of those were global events like the global financial crisis, right? There was
Hmm.
the Enron scandal, and a lot of those left people either with decimated retirement portfolios or without jobs, or in some cases, both.
Right.
And one day, as I walked into my office, I walked in only to see 70% of my colleagues being let go.
Wow.
So that was a pretty shocking moment, and it really hit home, and it scared me because the question I asked was, well, what if that happens to me? And being a sole provider for the family, that's pretty scary because you have only that one income stream, your W-2 to rely on.
Right.
And so as I reflected on what is it that I can control, I don't control global financial crisis or events. I don't control corporate restructures, but what I can control is what I do with my disposable income and the plans I make, the seeds that I plant today. And so I resorted to what I knew or what felt comfortable, which is real estate. And I
Hmm.
thought at the time, well, maybe I'll just get a single family home or two, and that will be my quote unquote retirement if God forbid something
Right.
like that happens to me. And so that's how I started, and I'm happy that I did it because it opened up a whole world of opportunities. It was extremely scary. I'm based here in California, and so investing here was not an option for me, partly because of the liquidity requirements, which are very much real even to this day.
Hmm.
But secondly, I was a cash flow and still am a cash flow investor. So great appreciation market, not so great for cash
Cash
flow,
flow. Yeah.
unless you buy all, yeah, unless you buy all cash, which I didn't have at that time and even today, to purchase multiple properties. And then the regulatory environment when it comes to residential tenants, in other asset classes, of course, it's very different, but in the residential space, it's just not easy to do business here. So naturally, that pushed me out of state. So scary experience to go outside my home borders, but
Hmm.
I've crossed the borders before, so I figured let me start with one small home, and if that doesn't work out, at least then I've tried it, and if there are losses, they wouldn't be devastating losses when you start small
Right.
before you go big. So that's pretty much how I started, and fast forward to today, I'm being a little vulnerable here, but I want to share that with you and your audience because that can happen to anyone. A couple years ago, I walked back into my office, right, thinking that I'm walking into a regular appointment with my manager, and I was told that our entire division is being shut down. So
Wow.
my colleagues and I, or at least most of us, almost all of us, except maybe a handful, are being let go.
Hmm.
And so at that time when that second occurrence happened, I was, of course, it still hurts even as I'm recollecting the moment, but at that time I had a peace of mind because by that point of time I had built a small portfolio that
Yep.
was cash flowing, not a ton but enough to cover very, very basic living expenses.
Hmm.
And what that created for me is not only peace of mind, but optionality.
Yep.
I had always wanted to start my real estate investment and advisory services business and do that full time. That was always a dream. Now,
Hmm.
in my plans, that was about 5 years from five years further out.
Right.
With the layoff, those plans effectively got accelerated. Um, but I share that because with you and with the audience, because it's important to plant those seeds early, right? Real estate takes some time to
Hmm.
germinate. It does take some time to see those income streams start to build one by one by one.
Right.
And if I hadn't taken that action, I wouldn't have that peace of mind and optionality. So going back to your original question, not only how I started, but why I do what I do is to be able to create paths for other individuals to build that optionality in their
Hmm.
own individual journeys, whatever their journeys are. So they have that peace of mind and optionality when they reach crossroads within their personal or professional lives.
Right. Okay. Okay. Yeah. So it's quite a story for sure. And I think that I might be not I might be might be biased. I am biased, but I think that everyone, if you have the ability to, you should try to invest in different things that can give you some level of passive income, so that you have different options, whether it's real estate, stocks, whatever. I think that that's the intelligent play for everyone. Anyway, okay. So, can you walk us through your first multifamily deal? Okay, and I want to hear everything, the good, the bad, the ugly. Don't sugarcoat, just share.
Okay.
Be vulnerable again, right? Share the lessons that you learned along the way. So just tell me what you can about your first multifamily deal.
Okay. Yeah, so I like to say that I like to crawl before I walk, walk before I jog and jog before I sprint. And that's the same approach I took when I transitioned from the single family residential space into multifamily. Yes, today I participate in and invest in syndications, which are large apartments, 150 plus units, but that's not how I started. I started with a small 11 unit JV, which was a deal maybe slightly smaller than what I was originally targeting, but it was the perfect training ground for me
Okay.
because it allowed me to learn the acquisition, the asset management experience, about partnership, all of that knowledge that I'm applying today in my larger deals so I can be better steward of capital for my investors and of course mine as well because I invest in all of my deals. And so the
Like
good
that.
part about the journey, I guess I'll start with the good. And as you requested and as I promised, right, I will not spare the bad. But the good is that I learned a lot
Okay.
from that acquisition. I learned a lot about partnerships. I learned a lot about property management, asset management, how tenant base can make or break a deal. And the good was that with this particular deal, one, it was underwritten well, and then two, it had multiple exit strategies. And I mentioned these two key points because they will become relevant when I share about the bad. So the bad is initially that was the deal was actually bought as a flip. It was a unique opportunity, 11 unit townhome with each townhome being individually parceled, which is what created the various exit strategies for us. And initially, we were going to flip the units, resell them at a pretty substantial margin, and be done with it within 6 to 12 months. But what happened was the Fed started raising rates pretty much right around the time when we were about to close. And so by the time we closed on the property, two things happened. Our initial lender had dropped off, so we ended up getting a short-term bridge loan with a fixed rate. So the rate
Okay.
there wasn't an option, but it was a short-term loan. And then secondly, the market turned, right?
Right.
With the rise in interest rates, people became nervous, skittish. So the whole buying market, both in the single family and the multifamily space, I don't want to say froze, but there was a lot of volatility there. So that basically caused us to take a step back and figure out what do we do, right? We're not able
Mm-hmm.
to sell the units. How about we hold it?
Right.
And we had a couple of options there. We knew that we had the debt, right? It had an 18-month maturity, so we had
Time.
literally a
Yeah.
year and a half to decide what to do, but we didn't want to wait until last minute. So we figured, well, if we're gonna, this is not going to resolve itself within a year, within 6 months or even less than a year. So let's refinance into permanent long-term debt. So at least
Mm-hmm.
we don't have that clock ticking. So we did, but the rates by that time had climbed. So we
Right.
ended up refinancing into a higher rate. And yeah, some people ask, well, why didn't you wait? Well, if we had waited, the rate would have been
Even
even higher.
higher.
So it wasn't the rate we were looking for, but that created a cash flow crunch.
Mm-hmm.
Separately, the insurance market collapsed. So that particular deal was in Florida. So our insurance doubled year over
Bro.
year. There were situations where we got dropped twice. And, you get dropped if there are issues with the property. In this case, it was a brand new, almost brand new 2000, I think it was 2004, 2007 built property, no proximity to water or flood zones, no crime zones. The roof was brand new,
Mm-hmm.
2022, 2023, something like that. I mean, very like brand new property. So, well maintained, no major deferred maintenance issues. So you check no aluminum wiring. I mean, we basically checked all the insurance boxes, right?
Right.
Nevertheless, it was just a function of the market. And so at one point of time, we had very, very healthy reserves, which is why I go back to the underwrite and the
Mm-hmm.
multiple exit strategies. But at one point of time, we had to make a decision. Do we want to? We started pouring at one point capital into the property right after the reserves ran out. And at that point, you have to make a strategic decision.
For sure.
do I keep putting more money into the property or do we sell? Probably at a loss given where
Mm-hmm.
the market is today. Um, or do you keep holding it forever? And when I I looked at the market and the calculations, right, it was my estimate that that's you're looking at least at 5, probably closer to 10 more years to hold it. Keep putting money in every month or every quarter,
Mm-hmm.
only to maybe break even on your initial investment. So that
Mm,
was
okay.
that
Yeah.
was my view. Well, there are four of us partners, right? So two of us shared that view. The other two thought that the market would appreciate by 16% year over year, and we would be done in the next 3, maximum 5 years. And so at that point, we agreed to disagree. They bought us out.
Mm-hmm.
Unfortunately, what I didn't see coming is even though the property appraised for more than what we bought it at, and we had added value, almost doubled NOI. So operationally, it was performing.
Yep.
But the partners made a very generous offer to buy us at pennies on the dollar, and
Oh.
that really, really hurt. That was a very ugly lesson. And so what I learned from it is one, for me, that the whole flip model was relatively new. We had leaned on a partner who had done flips before, so that was
Mm-hmm.
part of the risk mitigation on the front end, but not a model that I had done before. I'm a traditional cash flow investor, so lesson number one was stick
What you
to
know.
what works well for you and
Mm-hmm.
what you
Mm-hmm.
know.
Yeah.
Second of all, never, when you structure your partnerships, structure them as if you will get divorced tomorrow, right?
Yeah. 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 Yeah.
In this case, we truly thought that this would be a short-term deal. So we literally had a very basic operating agreement. And so when the buyout discussion started, emotions were heating up, feelings were hurt. I mean, these are some very difficult conversations, but if you structure it appropriately from the beginning, some of those feelings, emotions, and question marks would not have been there.
Exactly.
And lesson number three is market shifts. You don't control the markets. And so if anything, that taught me, at least from an underwriting perspective, to stick to my guns. And if I hadn't, we probably would have hit turbulent waters a lot sooner. In
Mm-hmm.
this case, the underwriting, the reserves, as well as the focus on operations really helped us last for as long as we did.
Yep.
For that reason, I personally would never compromise on my investment thesis. A lot of people ask me, what would it take to get outside of your investment buy box? And today the answer is nothing.
Nothing can bring you out of that. Mm-hmm.
Nothing. Yeah. Structure your partnerships well from the beginning and underwrite appropriately. So
Yeah.
those were the lessons learned.
Okay, okay. That's quite a an experience, and I'm glad you got out well on the other end, fine in the end, I guess. Okay, so let's sorry, wait for 1 minute, my dog. Can you hear my dog barking or no?
Not at all.
Okay, okay, great. It's crazy. Okay, so then we just continue. So after your first deal, how did your deal criteria shift? Like, did you undergo any changes in your deal criteria for the subsequent deals that you looked at?
Yeah, so one is I focus on larger properties now because there is the margin for error there is larger, right? It's
Hmm.
on an 11 unit, 1 or 2 units go vacant and you're at your
You're in
break-even
trouble.
occupancy
Yeah.
level, right?
Yeah.
On a larger unit, 1 or 2 units go vacant, you're fine. Now, don't let 90% or more of your units go vacant, but you have a little bit more margin of error.
Hmm.
Secondly, the importance of a market. I'm not as firm actually on secondary and tertiary markets, but as long as you underwrite those fundamentals well, the market is what will carry you through
Yeah.
good or bad times. Class B and C plus assets are my sweet spot. Not very
Hmm.
fond of C minus deals. And the deal must cash flow on day one. That's
Okay.
that's for me the non-negotiable. And when I say cash flow, I mean cash flow, not hey, I'm gonna raise this money up front so I can pay you distributions out of your own capital, which happens quite a bit,
Yeah.
by the way. Secondly, my risk tolerance. Now, I've always described myself as leaning towards the more conservative versus aggressive
Hmm.
side of the spectrum, but making those decisions and sticking to my guns, if you will, or adhering to my criteria, I believe has helped me avoid um, really bad situations. Knock on wood, I mean, at least as of today.
Yeah.
Of course, on the JV, I lost my capital since our partner graciously bought us for pennies on the dollar versus paying the appraised value.
Hmm.
But but for other deals, some are within my syndication portfolio, some are over, some are above projections, but they're cash flow positive
Right.
before distributions. And so adhering to my underwriting criteria, I think helped me. I didn't do a ton of deals during the hiatus day of 2020, what, 1 to 2022, 2023.
Hmm.
And that was difficult, right? Because you're talking to colleagues, your counterparts within the industry, everyone's closing a deal a quarter, and here I am closing a deal a year.
Yeah.
So that was difficult to swallow, but a lot of those deals are now either in foreclosure or going through capital calls. So that was a good lesson learned there. Is even though it was unnerving and difficult, adhere
Hmm.
to your criteria and your risk tolerance. Don't over leverage. I mean, I've never over leveraged. At most, I've gone 75% on a deal, but we're seeing the aftermath of over leverage today, right?
Yeah.
With
Yeah.
deals, specifically in the multifamily space, losing 20 to 30% of their value from the peak, right?
Hmm.
So if you entered into an 80, 85% leverage loan, you're
You're
currently
underwater,
underwater.
basically. Yeah.
So definitely that. And then in terms of mindset shifts, and I think we touched on that a little bit. Yes, early on, I thought that the spreadsheet, right? Spreadsheet tells the truth.
The story.
But now I know that it's more like a funhouse mirror, right? It reflects whatever assumptions you put in it.
Hmm.
Um, Real discipline really comes from questioning and vetting those assumptions, stress testing the deal, really understanding the downside, and really understanding the operator,
Yeah.
not only their background, but also their current operational expertise. And that you cannot capture on a spreadsheet. So.
Yeah, yeah. By the way, trust me, I know how, nerve-wracking and it can feel to see people closing other deals left, right, and center, and then you just going along at a much slower pace. But I think
Mhm.
that I definitely agree. If you have your criteria, you have your conservative ways of underwriting, stick to that, because you will sleep well at night if you stick to that stuff. So it's better, in my opinion.
Right.
Yeah. After your
Yeah.
first deal, did you undergo any mindset shifts? Like, how did your mindset change after your first deal?
Well, first of all, it was going from the 11 to write 150 unit. It may seem like a big jump, but all that experience that I shared with you, the good, the bad, and the ugly, gave me a really strong foundation and knowing that it is possible. Secondly, for me, it reaffirmed my investment criteria and my buy box in terms of
Hmm.
what I'm comfortable stretching and where I'm not comfortable stretching, and really realizing the importance of partnerships. When people ask me today, where do you start your analysis when you analyze a deal? The numbers is the last thing I look at. Of course,
Okay.
it's important. You have to understand the deal structure, you have to understand the numbers. There is a lot of art to that process, but a lot of it is science, right?
Yeah.
But the people element, people can make or break a deal, people make or break partnerships. One of the top 5 reasons why deals fail is failed partnership. So
Right.
you have to start there, and I learned my lesson the hard way. So
Okay. Okay. And then and one more bonus question. How long do you think it will take someone to become good at underwriting?
well, a lot of it depends on what work you put into it. So a lot of it
Hmm.
starts with you, but if you put in the work, you could be a confident underwriter in 10 to 12 weeks. And you may ask, well, how do you know that? Because I actually have a community and a program that teaches investors new to apartments to
Mm-hmm.
learn how to analyze a deal from beginning to end with confidence, clarity, and ease. I take them through that program and they're seeing results. So I know it not only from personal experience, but actually seeing the success of people within my community who have gone through the program and
Right.
done the work.
Okay, that's good. That's good. Hey, if you've got a real estate deal, a problem, or even just a question, we want to hear about it. Doesn't matter if it's big, small, complicated, ugly, or somewhere in between. If it's a good deal, we're absolutely interested. Period. And if you've got capital, you need to put to work in solid real estate opportunities. We've got those too. Either way, let's talk. Here's how this works. We always need more deals. We always need more capital. And we always find a way to make it happen. No games, no runaround. If we can't work together directly, we'll hand deliver you to someone who can. So let's talk about some tips and pitfalls, even though you already mentioned some of them there. So like what are your biggest lessons around finding deals?
Okay, so finding deals, relationships matter more than anything else because the best deals typically never hit the market. So if you're an operator, uh, usually brokers or sellers are the source of deals for you.
Mm-hmm.
If you're a fund manager or a capital allocator, then operators are your
Yep.
source of deals. And in both cases, relationships is how you get access to that pipeline and
Right.
healthy deals.
Yeah. Okay. I definitely agree there. And then how about what are your biggest lessons around operating and actually executing on a deal once you have it, under contract or once you've closed?
Asset management and property management is everything.
Mm-hmm.
Well, first of all, start with the partners, right? Choose people who are aligned. Make sure you have complementary experience and skills, right? If
Yep.
if all of you are underwriters, who's gonna raise the capital? Who's gonna raise the property? So starts with the people first, and then focus on operations and not just monitoring, right? The day to day, but having very specific key performance indicators and
Mm-hmm.
doing that frequently and proactively, right?
Right.
Don't sometimes it's not uncommon for property managers to push back on the level of information that you receive or on the frequency of communications.
Mm-hmm.
And as a steward of your and your investors' capital, you should push back, right?
Yeah. Yeah.
And
For
and,
sure.
and hopefully and hopefully those conversations happen before you get into the deal, right? While you're vetting the property management team, not after.
Mm-hmm.
But you should be having those calls in the beginning, especially, right? While you're repositioning the property, I would say at least on a weekly basis, but
Mm-hmm.
hopefully monitoring those KPIs on a daily basis, because that is your guiding light to show you how are you performing. You don't want to catch a problem a month later because
Yeah.
by
Yeah.
the
Yeah.
time you solve it, now you're maybe two, potentially 3 months behind. So
Mm-hmm.
you need to be on top of that. And from a capital allocator perspective, I would also, or even operator, because operators have their own investments, communication with co-GPs, with partners, including passive investing partners,
Mm-hmm.
LPs,
Mm-hmm. Yeah.
is crucial. Don't be afraid to get in front of the boss, right? Not everything goes smoothly.
Smoothly. Yeah.
It's not a matter of if, but when issues arise, especially during the stabilization period. You need to be delivering those news, as ugly and as bad as they are, as early as you can. The
Mm-hmm.
last thing you want to do is surprise your investors, either due
Right.
to ignorance, because you didn't know how to read the numbers or didn't know what was going on, because you're completely checked out of the deal, which happens
Mm-hmm.
very often, very often, or because you are afraid to deliver bad news. I mean, you've
Mm-hmm.
taken on that role and it comes with the good, the bad, and the ugly. So
Exactly. Exactly.
yeah, right.
Yeah, I think you always need to communicate clearly, effectively, and openly. The more open, the
Mhm.
better. Okay, and then the
Mhm.
final one is you touched on this a little bit, about having different exit strategies, but what are your
Right.
what are your biggest lessons around exiting deals?
Yeah, so definitely having multiple exit strategies. I will mention something that's near and dear to my heart, which is underwriting, right? And I see
Mm-hmm.
sadly a lot of that happening today. So when it comes to exits in particular, build realistic exit cap rate
Yeah.
assumptions. Don't ever underwrite based on cap rate compression just to make returns look good.
Mm-hmm.
Even if you're bullish on the market, even if you think rates and supply and all that will collapse and all of a sudden we'll be back to 3 and 4% caps, even if you firmly and wholeheartedly believe that, don't underwrite as such, because what if that
Yeah.
time
What if?
doesn't, or what if it doesn't come when you expect it to come? Now
Exactly.
you now you've overpromised to your investors and definitely underdelivered, and one could even raise some ethics questions in that regard, because
Mm-hmm.
if you knew that, why did you structure the deal as such from the beginning?
Exactly, yeah. And cap rates have such an outsized impact on like the sale price and everything, and then on the overall impact on the deal as well. So I think, yeah, you gotta maybe I think what I would do is I would present like a sensitivity analysis and show different cap rates. If we exited this, it'll be that. And yeah,
Mhm.
definitely under promise, over deliver is always a good strategy. Okay, so let's move on to the rapid fire round. Okay, so I'll just throw some questions
Okay.
at you. And you just don't think, just hit me with whatever the first thing that comes to your
Okay.
mind.
Okay.
Don't be politically correct, just hit me, right? Okay, so
Okay. All right.
um first question is what is your worst tenant story?
Oh boy, I don't know if it's necessarily worse, because I've definitely heard worse stories than that. But it
Okay.
was a skipper, right? A tenant. I had one of my units was vacant for a really long time. Finally got a tenant in. She had rented with that same property management firm previously, had a good track record, right? So she got approved, and within less than 3 months, I find out that she's no longer in the property, and she gracefully let us know after she had moved out of state and started a new
Wow.
job. And
Uh,
so it wasn't I mean, it's not a necessarily horror story. She didn't destroy the place per se, but you can
hmm.
imagine every time you turn a property, there is a significant amount of turnover expense. So I got
Yep.
hit double expense this time, this with this happening. And then, secondly, the property manager didn't quite go after her as hard. I mean, they kept sending her reminders and whatnot. And when I inquired if we can put the derogatory mark on her credit report, they said that couldn't be done, it's too expensive. Anyway, I recently actually found out about a third-party service that actually provides that. It's not thousands of dollars, it's not an
Hmm.
unreasonable cost. Of course, with like single family homes or duplexes, when you get into the few $100 expense range, you're pretty much wiping out substantial amount of your
Exactly. Yeah.
monthly income. So
Yep.
even though on the surface it's not a large expense, that's also something you need to keep into consideration. But anyway, I found out about this third party service, and while I hope this will never ever happen to me again, if it does,
You
I
know
am
who to
putting
use. Yeah.
that derogatory mark on their reports for not honoring their contract. So
Yeah. It's definitely not the worst horror story that I've heard, so you're fine. Okay, what about your favorite expense saving hack?
Gosh, probably it's a common one, but it actually can add up pretty quickly, and that's the utility bill back. Not all
Hmm.
properties do that, and sometimes they're not set up to do it, right? They're not individually metered, but
Right.
you can hire third-party services who can allocate within the regulatory limits, of course,
Hmm.
the ratio of the utilities that each tenant or each unit is using. So you're not going to recover 100% of your cost, but you can maybe recover 80% of
Yep.
or 90% of what you spend. So it's a little, little hack that you can do, and can be a great value add opportunity.
Yeah, for sure. I think Rubs is definitely up there in terms of expense saving hacks. And then, okay, so like there's a lot of advice floating around in the real estate world. Some good, some not so good. Just in your opinion, what do you think is some of the most overrated advice with respect to real
Okay.
estate?
Real estate always goes up.
Mhm.
It does not. It does not.
Yeah.
Timing, operations, and fundamentals matter.
Hmm. Yeah. Okay, and then conversely, how about the opposite? Some what advice do you think is underrated with respect to real estate?
Cash and cash flow are king. If you don't cash flow from day one, or if you don't have insufficient reserves, think twice before
Hmm.
investing in a deal.
Yeah, okay. I wholeheartedly agree with cash flow being king. All right, and then so I think I know how you'll answer this question, but I'm going to ask anyway. So we like to talk a lot about, superpowers. What is your unfair advantage?
Okay, I would say it's my commercial lending background.
Mm-hmm.
When I underwrite deals, I have both the investor experience and the lender experience, but underwriting like a lender or approaching a deal like a bank helps me spot risks or areas that maybe many sponsors or LPs may gloss over.
Mm-hmm.
So I would definitely say that's one, and being able to build strong relationships. That's the second one.
Okay, so you have two. Good, good, good. I knew you would say something about underwriting. I didn't anticipate the other aspect. So good, good for you. You double advantage there for you. Now I don't like to use the word like regret, but if you could go
Uh-huh.
back, what's one thing that you might do differently?
I think I hear a lot of people say I'll start sooner. As I reflect on that, of course, I wish I would have started sooner, but
Mm-hmm.
I didn't have the liquidity at that time, right, to start
Right.
sooner. Graduating from college, my main goal was to pay off any remaining student debt, build sufficient savings, and then build my investable cash reserves, and
Mm-hmm.
that takes time. So while I wish I had started sooner, I didn't have the financial capabilities, but even the knowledge, right,
Right.
to start investing. Now, I did when I first started, I was in 2017, and I took a little bit of a pause between 2018 and 2020. Part of it is because of my job. I had got on a promotion, changed positions at the time, and was solely focused on that. But secondarily, after I made my first investment, I wanted for some time to pass just to see how it works out.
Mm-hmm. Mm-hmm. Yeah.
I I think I may have taken um, longer than I should have. So that was probably that 2 year gap maybe could have been condensed to a year, maybe
Mm-hmm.
6 months. So knowing what I know now is what I would do differently if I was to rewind the clock.
Okay, okay, fair enough. And then, so what's your best advice for new investors? And first, let's classify the new investors as the ones who want to be passive. Okay, so they want to be
Okay.
LPs in deals. What's your best advice for them?
Okay. So I would say do not chase shiny objects. First of all, get very clear on what your goals are, investment goals, what you have affinity in. Pick one asset class. There are
Mm-hmm.
many, but start with one, focus on it, and really go deep and try to understand it.
Yep.
I believe that an educated investor is an empowered investor, and that's part of my mission today because there are a lot of glossy marketing materials and offerings presented your way, and yes, while the sponsors or operators doing these deals day in and day out have a lot more years of experience perhaps than you, and the operational expertise perhaps, it doesn't mean that you need to take their word for granted. So
Mm-hmm.
learn how to, once you're educated, you will know exactly how to vet their assumptions, which is why I'm very passionate about underwriting and cannot stress enough the importance of learning how to analyze deals. You don't
Right.
have to be a Wall Street banker, you don't have to be a commercial lender to learn the basics to a level that will allow you to poke enough holes and peel the onion to its core, even if it makes you cry, but better to cry before you get into a
Before the
deal
deal,
than
right? Then
after.
after, and when you lose capital or there's a capital call or something else. Yeah, yeah. I agree.
Right.
I agree. Okay, and then how about like what advice would you offer investors who want to be active? So either as GPs or something along those lines.
Yeah, so GPs, I mean, a lot of it depends, right? If they're operators, I like to see that they're focused on a single market, single asset class. If I'm
Mm-hmm.
placing capital with them, they're experts, right? I'm leaning on them. Of course, I'll verify everything they share with me, but I personally don't like to see operators hopping around different asset classes, different
Yep.
markets. Now, if you're a capital allocator or a fund manager, that's perhaps less relevant, right? The area of focus is perhaps less relevant, especially if your investors are coming to you asking for a variety of asset classes.
Right.
So
Yeah.
in that case, I would say do deep diligence. Yes, you're leaning in a lot still on the operator that you will place capital with, but go deep on that asset class and truly
Hmm.
understand it, right? So you can, again, going back to the basics, is protect the downside, right?
Right.
Protect the principle of your investments. And you cannot eliminate risk. There's absolutely no way you can eliminate risk, but you can mitigate it and hopefully minimize the downside risk by doing proper due diligence.
Yeah, okay, I agree. And then so let me see. I think that was the last question that I wanted to ask, but is there anything that I didn't ask that you wanted me to ask because you wanted to talk about it, or you think that someone who's watching this interview, they might like me to ask that question? Hope that makes sense. Yeah.
Yes, yes.
Yeah.
So probably the only one I would highlight here is my why, which is important, right? Real estate is not just about the numbers, but for me, it's about building freedom, building optionality, creating stability for my family, and helping other business owners and other professionals do the same, and whatever freedom and optionality means
Hmm.
to them. So,
Yeah.
so that's something that I wanted to share, and that's what keeps me going. Some days are great, some days are
That's so
difficult,
great.
right? And
Yeah.
so that why keeps me going forward. And secondarily, not in importance, but you probably heard me mention education multiple times throughout our conversations, and that's a very near and dear topic to my heart, and namely the opportunity to create educated and empowered investors, or help people become educated and empowered investors through the activities that I do through my business, as well as the educational content that I publish on a daily basis.
Okay. Okay. And so are there any resources that you want to share or any projects that you're working on that you can share and let us know about or yeah.
Yes, actually, I'm very excited about I very briefly mentioned it, but very excited about the underwriting community that I lead, that also comes with a self-paced course. And I just finished writing a book on
Hmm.
underwriting
Oh,
apartments for beginner investors to multifamily. That also brings that unique lender angle that I think is missing from a lot of workshops, masterminds, and whatnot. So I will be launching the book before the end of the year, and once that is up and about, I'm happy to share information. But very
okay.
excited to see that project come to fruition, because it goes back to a, my passion and desire to help others at least minimize the risk of loss by going through the due diligence process, and underwriting being one key component of that upfront due diligence process.
Yeah, sure, sure. A book. Okay, that's definitely very exciting and I'll have to keep an eye out for that. Yeah. All right. Okay, well, I think that was the last question that I wanted to ask. So I have all your contact information. I will, drop it on the video and drop it in the description as well. So Vessi, thank you very much for joining me today. And maybe I want to invite you back like 6 months, 12 months later, probably after your book has been launched, and then we'll see how your progress is going and what changes you've made and how you're doing. Yeah, but again, thank you very, very much for joining us today. I think you've added a lot of value to anyone listening and also to me. I've learned a lot. I learned something today, so that's always a good thing as well. Yeah.
Absolutely. Thanks for the warm invite, and I enjoyed our conversation.
Okay, thank you. Bye, everyone.